This is Scott Pulsini from scottpulsinitrader.com, and this is our second indicator setup called the Titanic. We're going to shorthand form as T in the examples. Take a second to look at this disclaimer quickly. I'm not going to read it again. It's 2 pages. Okay, so this is our bookmap.com stop iceberg indicator setup number 2, called the Titanic again. So Titanic is a setup where a market runs into a hidden iceberg order and immediately rejects the area. Icebergs are large players, smart money we call them, that surprise the market as a wall of hidden orders that populate once the visible limit order that is showing in the book is traded into. So again, I went over this in the introduction, what icebergs are, but again, they have to show a certain percentage in the order book, and then when it's traded into that percentage, the rest of the amount populates the order book, which it turns into a wall of orders many times because the size is so big. And again, we have our thresholds for each product. What is a big iceberg versus a not big iceberg that we take action on, which you have the PDF for that as well. Icebergs aren't always correct in market direction, but they are correct more often than not, 70% plus in my studies, and it's an advantage to know what direction the big money is taking. This trade is taken either once you see the market orders come in, bubbles in the direction of the iceberg, that's aggressive entry, or when the market moves away from the iceberg, retest, and then the market orders then start initiating in the direction of the iceberg. That's conservative. And we'll go over the different examples like we did with the Dumb and Dumber setup. Okay, here's some examples of the Titanic. So T is obviously the shorthand form for Titanic, and then minus means it was a sell iceberg, a sell setup, versus plus is a buy setup. So this was 6E euro, where our threshold for the iceberg is anything over 100. That's what initiates our interest or has us ready to take a trade. So you can see here the iceberg, sell iceberg, again, anything below 0 is a negative iceberg, sell iceberg, meaning there were offers, hidden offers in the book as the market came into that price. Again, this is after the fact, but at this point when it was up here, it would only show as, say, a 10 lot, and then or a 15 lot, and once the market starts to buy into those orders, it turns into a 150 lot, right? So it's kind of a surprise type of sell order where, again, the big money doesn't want to display what their true intentions, but when the market runs into it, it many times runs the other way. There's times that it does not, and it fails. Again, I'd say it's about 30% of the time that it does not, hold that area, and we have a setup for that as well. So again, 70% of the time in my studies, the icebergs are correct. And, again, it's just common sense. You want to be on the side of the big money, right? As smaller retail traders that I'm assuming most of us are. Now, again, that's what I am nowadays as well. We don't have the type of size as far as orders to push the market around. So you want to be jumping on the coattails of the big money. So this is an example where we came up to right around here was a sell iceberg, and again, when you see the sell orders initiate in the direction of the iceberg, right, because we have a sell iceberg, that's where you can enter. Stop goes above this area. Again, 6E is one of those markets where many times it will go a little farther and then it'll go, right? So in this instance, it didn't go too much further. Your stop should probably be a little bit above anyway, but if you did get stopped out, again, you can just re-enter when you see the next sell bubble. Again, be ready to re-enter in some of these thinner markets like the 6E, some of the other currencies, and NASDAQ, and gold as well. So anyway, so we're in this trade. You're risking here, and you catch, many times it'll retest too. This didn't make it all the way back, obviously. There was more in this area. But again, if you want to be aggressive, then you're in the minute you see the selling come in here or here, and then your stop goes above where the sell iceberg fired off, which is right in this area. And then you're riding you're risking in this instance, we were risking, let's say, this is right around 80 to maybe a little bit above 90. So we're risking about 10 ticks, to catch a, this is probably 20 at the time. This is about a 20 plus point or tick move. So again, we're looking for multiples on our trade, but we're trading in the direction of the iceberg in all of these examples. And right there. Okay, so our next example is, this is the E-mini S&P. So our threshold for the E-mini S&P for icebergs is anything over 700 is a lot and something to take note of. This was obviously a monster iceberg. This was at the end of the day, and sometimes you got to be careful of the end of the day orders because you're going to see a lot of counter. You'll see buy icebergs, sell icebergs, buy icebergs. But when you start to see this kind of size, 2,700 is a lot. It's almost four times the amount that we look for, whether it's at the close or not. You want to see again if it rejects that area. And the market, heavy sellers, these are the red bubbles, heavy sellers, right into the waiting iceberg, right? The buy iceberg, 2,700 contracts, and the thing just turned around and took off. I have this chart kind of scrunched together, but you can see the blue here. If I hadn't expanded more, this would be a bigger blue bubble, but you can get in right here, right around 42.50, and you're catching almost a 10-point move on the trade, not risking down below here. Again, if this was spread out a little more, you probably wouldn't have to be risking 7 points on the trade, but because you'd see blue earlier than at this point. But in this example, I had it scrunched up. The point is, the setup is the buy iceberg, market running into it, running into a wall of buy orders, 2,700, and then turning around and going the other way. Next example is so all these examples, I may have the stops in there. I don't want to confuse people. So for instance, this was only 25 stops. It's nothing to pay attention to, especially when I'm showing this type of setup. As we get into other examples, other setups, we'll talk about both. So this was NQ. So you can see here as the market came down, there was heavy selling, and then all of a sudden they turned around and tried to buy it right here, and they ran into a wall of sell orders, 183 sell orders. So again, our threshold for NASDAQ is over 120, or over 120 for icebergs, 100 for stops. So they turned around, tried to buy, and it was another surprise. Here's almost 200 sell orders for you guys to take when they're, these algorithms are expecting just to run this thing back and forth, as anyone who trades the NASDAQ knows, and they run into a wall of orders, and then they got to turn around and puke out of the position. So that's the whole basis of the setup. So your entry is, the minute you start seeing some red come in, you're in there, which was right around 88-ish. Your stop goes above here. So again, like I talked about before, NASDAQ's one of those markets where you did catch, if you're in right around 88, you catch a 13-point move and it comes back. Many times it will go a little bit above the area, right? So you just have to be cognizant of that, where you can either put your stop a little higher, risk a little more, because when you do catch one, it's going to be a monster 30, 40 plus point trade or tick trade, or points, I'm sorry, not ticks, points. But even if you get stopped out, so say you put your stop, right here, and you got stopped out, you just re-enter when it gets back below that area, right? And then just try it again. Again, some of these markets you're going to have to take one or two tries, sometimes three if you're comfortable with that. Just knowing in advance that may happen, it's not gonna freak you out and cause you mental anguish if it happens, right? Because again, you're risking 8 points, 7-8 points to be making 50, 60, 70 points. So just keep that in mind when you're trading. Again, the markets that this happens quite often, where it goes a little bit above, is NASDAQ, gold, bonds tends to do it, 6E. So just be aware of that. Next example is, this was natural gas. So we had 102 contracts traded there as buy icebergs. So our threshold in natural gas is 100, so it's right on the threshold. It's worth a trade, right? So you see the heavy selling come in right into a wall of orders here. And then, again, I had this kind of condensed, but, the blue bubbles came in probably right around here. Even if you waited for more significant, you can get in here, and you're only risking, this is, if you just waited for this is 72 down to, 66, so you're risking 8 ticks. And what you'll see here, again, is, retest, 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 all in this area, right? Retest, retest. No one said that trading's easy and it's going to be just boom and you get your move, right? Sometimes you're going to have to go through this where it keeps coming down and retesting the area. But again, it doesn't matter if this area is important to you for what you saw. You know that it shouldn't violate it, right? So they can retest as many times as they want. You're on the right side of the market until proven otherwise, right? And then they finally succumb, and then you get the monster 40, 50 tick move. Again, risking 8 ticks. So just be aware. Not every time is it going to do. Many times it will do. You'll say this was here. Say this was this over here, right? And this many times you'll get the retest gone, right? So, but just be aware it doesn't always happen right away. But you're on the right side of the market. Next example is this is bonds. This is kind of a different look. Bonds is a little weird sometimes, but it's still the same, same premise where you're watching this, and you see these icebergs start to come in. So we're looking for over 200 in the bonds. That's our threshold. Again, you guys have the PDF and the threshold. That was right around here, right here, and then you get some more coming in here, and then you get some more coming in here. Again, you're not buying this. The minute you see, this is a perfect example on how you're not just buying when you see an iceberg come in, right? You want to see some buying come in. You're not, because again, there's an actual setup that we call breaking ice, which we'll get into, where you're not getting in until you see the market participants fighting back. Because again, paper is not always right. Again, my guess is from my studies right around 70%. But right here, there's no reason to be getting long until you see the market buyers being aggressive the other way, right? So, but you still want to be cognizant of this area either way. So you had icebergs, and then you come up with another setup, which we'll get into, the double whammy. But even if you don't have the stops and you're not looking at the stops, the second you see the buying come in, you're in there right around 176.06 ish, and you're risking down to 02, or you can go a little bit below this liquidity too, like we talked about in other examples. This liquidity is important. If you want to be a little more aggressive, a little bit looser with your stop, you can, meaning they would have to bust through this liquidity on top of all these icebergs that took a stand too. But if you don't want to, you're risking 4 ticks to make this is a 18 tick move and counting. When I took this was live market at the time. But again, you're risking 4 to make 18. You're making more than 4 times your money on the trade, and that's the whole idea. You want to find these areas that are significant, and you know exactly where you're going to be right and wrong. You wait for the opposite side to come in, or the side in the direction of the icebergs, and then you're playing for the move. Next example is these are 2 different examples, but we've learned, you guys have already learned the Dumb and Dumber. So this was kind of a double whammy, which we're going to get into too. It just wasn't at the same time. You guys will see this shortly in the next video, but usually double whammies are right on top of each other. This is kind of a separated double whammy where you get the stop run and then you get the sell iceberg. So this was British pound 6B. Our thresholds in 6B are over 80 icebergs. And over 70 or over in stop runs. So if you're just looking for the Dumb and Dumber setup, you would have been potentially in this trade when you saw this, right? And then if it's immediately below, and then the minute you see the red, you're in. Your stop's over here, and then you're in. Then what happens is it comes down a little bit, and they try to buy it back up. That's what this big blue bubble is, and they ran into a wall of sell orders. Again, you may not think 83 contracts is a wall, but in this contract, it is in the British pound, that is a lot. So they run into a wall. They're like, oh no, that was more than an 8 lot, and we got to puke. And the minute you see the red, so this could be two separate trades as well. So you could have taken the first trade on the dumber setup right there, and then when you see the iceberg, sell iceberg initiate, and you see the red here, and you're catching a very nice move. Risking very little to make multiples on your trade. Next example is, this is soybeans. This is again 2 different setups combined in this example, but you have here, so you have the market, let me clear this out. You have the market moving up, and then they try to sell back down here, ran into some liquidity, and then they tried to sell it, and they ran into a wall of buy icebergs, 319, and then it went a little higher, and they tried it again. They tried to sell. Here's another little surprise for them, 268, and you can see it, went higher from there. So you could have initiated when you see the blue come in here, or you could initiate it here, right? So when you see the selling and then the blue, you could initiate it the first time here. You could have added when you saw the second time here, right? So you're in it, maybe this was 844 and a quarter, and then you could have got in again, probably right around here, 845. And this came up to almost 848, so that's 4 cents. Risking, you weren't risking much. You were risking maybe a cent and a half, right? That's below this area, the first iceberg, and then the second iceberg came in. You can add it. The point is, whatever you're looking at in the chart, this wasn't a clear cut. Let's get out here, but it could have been VWAP, could have been, again. We're just looking at this as on its own, a standalone type of thing. Where if you're looking at something else as a target, this could have been it, right? But even if you weren't, this comes down, and yes, it does violate this first iceberg, but you can see the retest held exactly where this iceberg, the big iceberg, came in, right? Retest, 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 no dice, gone, right? So again, markets aren't always just going to perfectly run your way immediately, and sometimes they're going to come back. But now you understand what the rotations mean, right? The rotations are just them basically coming back down and then seeing if they can get it back through here. And there's just no selling. Could get it through this, where this big buy iceberg was before. Got a little lower than this one. And then, you hold the trade. And in this instance, again, you could have been looking for something on your charts, whatever this is, a moving average, VWAP. Again, I don't have that. I'm not using that as my examples here. I'm just trying to teach you guys the setups. But if you held it, you already know the Dumb and Dumber setup. This was the Dumb and Dumber, and I don't have the, this was over, we look for over 100 in stops. This was at least 150 here, 160. So the point is, you could have held this, and you could have got out of a piece here, whatever you're looking at, held it again, comes up here, starts to bust through, and then you see the Dumb and Dumber, and then you see it automatic, you see it fail immediately below, which we just learned, never gets above it, and you could be out of the trade, or you could be out of everything and then initiate the short, right, on this setup. So again, you're seeing how these kind of all flow together when you're seeing multiple things where you can be holding your contract. Say you put on 3 units, you get out of one at a certain level, you get another one at a TAS indicator, as an example, and then you're not getting out of the last unit until you see the opposite side come in, opposite setup, and then you get out, and then you flip, and then you go short, right? So it's just an example how powerful this is. Next example is the silver market, where we had, you can see the buy icebergs here. Get my little guy right here. They tried to sell. We rallied up, tried to sell down right into 191 buy icebergs in silver, and our threshold in silver is, I believe it's 170. So again, this was almost 2.5 times a good our threshold, right? So that's good. So they tried to push it down, failed, came up here. Again, when you see some blue, you can be in. Again, this is a little scrunched together, but even if you're in right here, you can be long here, risking below here, right? Let me clear some of this out. This is your risk. You can be in here, or if you're conservative, this one did come back and retest, right? Came back and retested this area, and then again, the buyers came in. Now you're in, and again, if you may be looking for something on your chart to help you get out of a piece, but then you see the opposite setup, the Dumb and Dumber setup, where the stop run fired off, it's immediately below. Now you're looking to get out or go short or get out of a piece. Again, our threshold for the stops is 50, was pretty close. Not that you have to initiate a short, but you should definitely be cognizant of this firing off and being wrong. Again, if you're long, you want to see the stop fire off and then the market staying above, right? And we'll get into that. That's the stop and hold setup. But if it's immediately below, you got to be thinking about, okay, I want to take some profit here. So this wasn't a huge trade, but it's showing you, again, this is kind of condensed where you could have got probably a better entry right in here, blue bubble wise, and risking below here, and then you can catch that move up to there. Next example is, this was bonds again, where you had, heavy selling, pull this up here, heavy selling here, into really big buying icebergs. 520, remember 200 is our threshold, where Anna was in the resting liquidity, so this is visible liquidity, meaning there were bids in the book that got that were saying take my orders, and then there were hidden bids in the book as icebergs. So you had kind of a double. It's not a double whammy in our parlance, but it was a kind of a double signal, and you get the move away, you get the retest. So you could have been long here when you get the blue. Stop goes below here. Let me pull this off. Could have been long there. Initiate. Stop goes below. Or if you're conservative, you wait for the retest there. When you see the blue, you get in there. If you're aggressive, you can get in here, wait for the retest. You see it fail, you can get in, you can add, and then again, your stop's very close, right? You're risking, in this example, you're risking at this price point was 178.11 ish. This price point was 178.09, and you're risking down to what's this, 06 ish. So you're risking 3 to 5 ticks to catch a good. This was a 10. Oh, and then, so yeah, this was the rest of this trade where, you want to stay in as long as possible, obviously, but, that's where traders really struggle is, well, when do I get out, right? So you're getting out at certain levels, again, the TAS, market indicator stuff, or stuff that you look at. But if you see an opposite, this is the opposite that came in. So you see it run up here, and then you see some really heavy initiative buying right into a sell iceberg, right? The exact same setup. And then it starts to fail, you're out. So you make, 8 to 11 ticks on depending on where you got in, and you get out. Yeah, you want to make multiples. That's the goal. You want to be making 3, 4, 5, 10 times your trade, but you're not going to ignore. You're not going to get in for one reason and then see the same setup the other way and then ignore it, right? You get out and take your profit and move on and wait for the next trade, right? So again, it's not always what you want. You're not trading off what you think, right, or what you want. You're trading off what you see. In this instance, you're not getting 3, 4, 5 times your money because you get the opposite, signal, this, and then you're out. It's still a nice trade, especially in bonds that are $31 a tick, $31.25 a tick. Okay, our next example is this. These next couple are different, little different looks. But you can still see how they're, it's still a very powerful trade where, so you come up here, you get sell icebergs you get this here, you get 1,300 sell icebergs waiting, immediately rejects, you can get in here, you catch so this is right around, 30.21-ish you'd be in, and you get a 6-point move, right? Again, this could have been VWAP. We're not using any of that in these examples, obviously, but even if you held on, clear this out, even if you held on, your stop may have been this pretty tight right above it. You want to go a little higher, but whatever. Say you got stopped out, right? Say it went 2 ticks. I mean, this is my MO, getting stopped out to the exact tick. You get stopped out, you see it again. Another 900 it ran into, you're in again, right there, right? Or right here. Goes again. Doesn't go anywhere as far. It comes out. You get stopped out again. Okay, I'm done with this trade. It's making me mad. I'm done. I don't want to keep putting my head against the wall. Then you see this, right? And you're like, okay, wait a second. I'm going to give this one last chance. I mean, these sellers are bound to win here. They tried it here. They tried it here. Again, you say you got in twice and say you got stopped out twice. Now you get in for the third time. And this isn't even the same trade. I said earlier, I've said multiple times, where you want to be getting in, you might want to give it a couple tries. So to say this came up here again and this wasn't even here and this wasn't even here, right? Say it was just nothing. It just blew through and stopped you out. You want to give it one more chance. If you get stopped out again, you may want to give it 3 chances, right? But then when you incorporate huge icebergs, huge sell icebergs twice, now you're saying, okay, I'm giving this another chance. This is a brand new trade now, right? This was a new trade. Okay, great. You get stopped out. Now you see it again. Now you finally get, again, this is what I'm talking about. You may get stopped out a few times, but when you catch the move, then you catch the 4, 5, 6 times your money trade, right? So you can afford to be stopped out a couple times, 2, 3 times. And when you finally catch because the odds are in your favor, right? You're probably 70% on this trade over the long term. You're going to make money even if you're wrong 3 times and the one that you catch goes, this was a 20 plus point move, right? So I hope you guys are seeing how it works in trading, right? And everything's just not black and white. And you got to be taking multiples on your trade when you're right, if it permits. Again, like I just showed in the prior bond example, if I would have seen, in this trade, if I would have seen right here, this was a monster buy iceberg right in here, right, which it wasn't, then I would have been out. I want to catch 20 points, but if I don't see anything, but if I see something that tells me otherwise, then I'm out. But you didn't see anything to tell you otherwise. Look at this. This is nothing. This is you catch a 20 plus point trade on this trade. That's a little different look. And then this last one, let's see here. Same type of thing. So this was at the end of the day too. And again, you want to be careful at the end of the day because obviously there's going to be more size flowing through the market most times. But when you start seeing, 2,600, 2,700, 2,500, now you can participate, right? So this was a different type of look where you see this first iceberg, this was like 2,600 here, right? And then it started, so you could have initiated along here. Then this whole way they kept trying to sell. You see these red bubbles, you see the red bubbles, see the red bubbles, see the red bubbles. This was just a wall, absolute wall of icebergs, right? So this was your first boom, boom. You can get them in right here on the blue. Stop goes down here, right? And then it pops up and they still try to hammer it. And there's just tons of icebergs saying, I'll take it. You're watching this happen and you're saying, as soon as I see blue, I am in. Okay, you could have been in here and then you see this. Now your mouth's just watering, saying, okay, let me see some more blue. Let me see some market initiation on the buy side, and I am in. And so you say you get in right here for the first part, and then you see this. You can get in for another order. You catch a 10-point trade right at the close. This is a couple minutes, right? So it's like you can see how everything's just not laid out perfectly as far as icebergs, where it just hits the thing and then goes, and then it kind of dies down. In this instance, the icebergs were just there. They tried. The sellers tried. They tried, and whoever was taking these orders was not having. This is 7,000 contracts taking. So again, I don't have the overnight session. I'm sure this went even higher, just because whoever sold into these was in a lot of pain very quickly. Okay, so that'll conclude the Titanic setup. You can see how powerful it is, again, just like every setup I'm showing. And then you can see how you can use it in conjunction with other setups or different levels that you're looking at. And then when you see this stuff come in at a level, that's very big, sorry about that. But when you see these kind of things coming up at levels that you're looking and say this was a 100-day moving average or a VWAP or Fibonacci or whatever you look at, and then you get confirmation with this stuff, it's just golden, right? Okay, I will be back with the next setup. Thank you.